Hey, what's happening, guys? Dan Darrow here with another Options in Play video update. So today's video, it's going to be about a little bit different of a trade setup than what we've had on recently. It's going to talk about Oracle. It's a calendar call spread, which in and of itself isn't that much different, but the rationale behind the trade and what we were looking for. So why we got in and what we were looking for, definitely much different than your typical run-of-the-mill calendar spread. And really, like this is something that's kind of unique, even more so to option trading. You're not going to see this in stocks or equities, and we'll talk about why. So typically, when we play a calendar spread, we are looking for a stock to stay below or stay above if you're playing like a calendar put spread, obviously. So you're looking for the stock to stay below a certain price in the near term. So you want that short term call to expire worthless, right? So you want the stock to stay below a certain price in the near term, and then after it expires, you want the stock to rally past a certain price over a longer time frame. So over the course of the longer term expiration call that you're long as part of the spread. And basically, counter spreads are looking to take advantage of near-term implied volatility to help offset the price of longer dated position. So I'm sure a lot of you guys are familiar with calendar spreads and kind of how to use them, what you're looking for. Uh, if you're if you're just joining us, we have done a bunch of calendar spreads. We like calendar spreads. We like the idea behind them. We tend to use them more on stocks that are in well-defined trends or have, say, well-defined levels of support resistance. And basically, it's a play for a trending stock. It's a play that the trend is going to hold. So if a stock's at the bottom of the trend, then you could use a calendar put spread, or if it's at the top of the trend, excuse me, at the top of the trend, calendar put spread, the bottom of the trend, calendar call spread. You basically, like, for stocks that are in trend, you're anticipating the stocks to stay in the trend. So, selling premium or selling near-term implied volatility can be a really, really profitable strategy. Oracle, on the other hand, was a little bit different. So, um, this one is this one was a play on the earnings date, so not a play on the direction of the stock necessarily, but a play on the date of the earnings release, which sounds strange, but it's actually kind of interesting. So let's talk let's talk through it and kind of like give you an idea of what we're looking for here. Um, so some companies confirm their earnings date several weeks or months in advance, so there really isn't much uncertainty about the timing of when they're going to report. But then there's other companies that won't confirm until a few days or even maybe like a week before they're supposed to release. So the option market can really have some inefficiencies. And what that means is, especially like a stock like Oracle that has weekly contracts, what you're going to see is that there's going to be a lot of there's not a lot. There's going to be options that are mispriced based on what traders' expectations are for when the news is going to be released, right? So if traders are expecting a company to report on a certain week, for instance, and say the company confirms that it's going to fall the week after, then those options that were pricing in an earnings report are going to lose a ton of their implied volatility overnight because options that have a catalyst are going to be more expensive. So if the company confirms that it's going to fall the week after, those options are going to lose. Even if the stock stays flat, those options are going to lose value overnight because of the major implied volatility crush. And on the flip side, say people were expecting the company to report the week after, but they unexpectedly move it up until the previous week, and the options that were trading at a smaller implied volatility will jump dramatically overnight, because then all of a sudden, contracts that didn't have a catalyst all of a sudden have a catalyst. So you can see how, when there's uncertainty around the date, how there's definitely some opportunity to make money off the timing of that release. And that's kind of what we're looking at Oracle, because when we were game planning for upcoming earnings in the month of September, it crossed our radar that Oracle was going to be reporting, but they hadn't yet confirmed their date. And as of right now, they still haven't confirmed their date. But what we were seeing based on the sites that we checked was that Oracle would be reporting either between the 12th of September through the 17th of September. So it was kind of like mixed opinions when it would be. But that was really like the window. And that wouldn't normally be interesting, but when you look at the option expiration, the 12th, so there's 14th expiration, and then there's 21st expiration. So the window lies between two contract expirations. So that to us really, like ding 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 on our radar. It's like, okay, like there's potential here. And what that means is if Oracle confirms their earnings date after the 14th, then those contracts will probably see a pretty sharp implied volatility crush, because when we were looking at the trade, I mean, they weren't I mean, the 21st expiration calls were trading for a little bit more, obviously, because there's an extra week of time value, but also because the option market was anticipating a higher percentage chance that it was going to come the week of the 21st. But the 14th expiration, we're still trading at a slightly elevated implied volatility, because traders, maybe they didn't think there was a 99% chance that it happened the 14th, but they thought maybe there was a 60 or 70% chance it came the week of the 14th. So to us, what we thought was interesting would be a calendar spread where you short the week of the 14th and you buy the week of the 21st. And really, the way you benefit is if they announce that it's going to come on the week of the 21st, then the 14th should see a implied volatility crush, and those contracts should lose value, while the 21st week contracts should hold on to their value, relatively speaking. And as you can see, what happened is, Oracle, like the stock pulled back, and the calendar call spread was the 49 strike call. So the stock pulled back, and what you saw was that the 14th expiration contract, so the September 14th 49 strike call lost about 75 to 80% of its value, because as of right now, as of this video, Oracle still had not released their earnings date. So people are starting to suspect that it's not going to be next week. So that contract lost 75 to 80% of its value. Its implied volatility is currently around 16.5, whereas the September 21st expiration call, the 49 call, is lost about 20% of its value, and the implied volatility on those contracts is closer to about 35. So you can see that the market's already starting to move in that direction, even though the company hasn't confirmed. So, this was a different setup, and they haven't even confirmed yet. But you could cover the trade here without even having to wait and have that release come out, because even though the stock dropped, the 21st expiration calls are still holding on to a majority of their value, while the shorter term 14th expiration have really taken like a serious hit due to that implied volatility crush. And I know it's a lot of technical stuff, and it's a lot of very option specific, but we felt that this was a really interesting, different, unique trade, because it didn't really involve levels, and it didn't involve price points. It just involved expirations and time differences, and that's why we thought it was really interesting, and we wanted to highlight it in a video here. So, as always, please reach out if you guys have questions, comments. We love to hear from you. Have have a fantastic day of trading. Enjoy the weekend, and lots to look forward to. More news coming next week. So rest up, relax, and we'll talk to you next week.